Hello everyone, I am Suhaib Ahmed and today I will be presenting on budgeting. In this topic, I will explain the basic concept of budgeting and the key compliance requirement for business. During this presentation, you will learn about the budgeting, its importance, and types of budgetings. By the end of this presentation, you will have a clear understanding on how budgeting works. Let's begin. Budgeting. So, start from the definition of budgeting. Budgeting is the process of planning and controlling financial resources by estimating future income and expenses over a specific period. It helps individuals and businesses ensure that resources are used efficiently and financial goals are achieved. Importance in financial planning. Budgeting is important because it improves financial controls, supports decision making, helps in performance evaluation, identifies financial risk early. Objectives of budgeting. Control expenses. It ensures that expenses are monitored and controlled, preventing overspending and waste of resources. One of the objectives of budgeting is plan future activities. Budgeting helps organizations plan their future operation by estimating income, expenses, and resource requirements. It also improves decision making. Manager use budgets as a tool to make informed financial and operational decisions. It also ensures financial stability. By controlling cost and planning revenue, budgeting helps business increase profitability. Now let's move toward the types of budgets. So number one is operating budget, number second capital budget, number third cash budget, number four flexible budget, and number five master budget. We will explain it in detail later in this video. So steps in budgeting process. First step is set financial goals. Define clear goals like profit targets, cost reductions, expansions, align with overall business strategy. Estimate income. Forecast expected sale or income. Use past data and market trends. Estimate expenses. Classify cost into fixed asset like rent and salaries, variable cost like material, utilities. Estimate all expected expenditures. The fourth step, prepare budget. Combine income and expenses. Prepare different budgets like cash, operating, etc. Ensure balance between inflow and outflows. Monitor and adjust. Track actual performance. Compare with budgeted figures. Now, what is operating budget? An operating budget is a financial plan that show the expected revenue and expenses of a business for a specific period like monthly, quarterly, or yearly. It focuses on day-to-day business operation. Purpose of operating budget is to estimate income and expenses, to control operational costs, to ensure smooth business operation, to ensure profitability. Now components of operating budgets. So first of all, revenue budget, production or purchase budget, direct cost, and operating expenses. Key factor. So it's a short term, usually 1 year, focus on daily operation, forms part of master budget. Now let's move toward the capital budget. So capital budget is the process of evaluating and selecting long-term investment projects that involve significant amount of money. It helps business decide where to invest funds for maximum return in the future. Purpose of capital budgeting to evaluate investment opportunity, to maximize long-term profitability, to ensure efficient use of capital to support business growth and expansion. Technique of capital budgeting. Number one is payback period. Number two, net present value. Number three, internal rate of return, which is also known as IRR. And number four, accounting rate of return, which is also known as ARR. Now, steps in capital budgeting. Identify investment opportunities. Second, estimate cash inflows and outflows. Third, evaluate projects using financial techniques. And fourth, select the best project. And number five, implement and monitor. Key feature. So it's long-term in nature, involves large investment, high risk and uncertainty, decision are irreversible or difficult to change. Now let's move toward the cash budget. So a cash budget is a financial plan that estimates the cash inflow and cash outflow of a business over a specific period. It helps ensure that the business has enough cash to meet its obligation. Purpose of cash budgeting: to maintain adequate cash balance, to avoid cash shortage, to plan for surplus cash investment, to ensure smooth day-to-day operation. Components of cash budget: opening balance, cash inflows, cash outflows, closing balance. And the key points is that if profit not equal to cash, a business may be profitable but still face cash shortages. Flexible budget. Now, a flexible budget is a budget that changes or adjusts according to the level of activity or output. Unlike a fixed budget, it is not static, it adapts based on actual business performance. Purpose of flexible budget: to provide a more accurate comparison with actual result, to adjust cost based on activity level, to improve cost control and decision making. How flexible budget works. Costs are classified as fixed asset, fixed cost, and fixed costs remain constant like rent and salaries, and variable costs change with activity level like material and labor. Advantages of flexible budget: more accurate and realistic, better performance evaluation, helps in cost control, useful for dynamic business. Limitations: require proper cost classification, more complex to prepare, need regular updates. Key features: adjust with production or sale level, separate fixed and variable cost, more realistic than a fixed budget, useful for performance evaluation. Now, what is master budget? A master budget is a comprehensive financial plan that combines all individual budgets of a business, operating and financial budget into one overall plan. It shows the complete financial picture of the organization for a specific period. Purpose of master budget: to provide an overall financial plan, to coordinate all departments, to assist in strategic decision making, to control and monitor business performance. Components of master budget: number one, operating budgets, and number two is financial budgets. And the structure of master budget is operating budget plus financial budget equal to master budget. Importance of master budget: so provide complete financial overview. It improves coordination between departments. It helps in performance evaluation and it also supports long-term planning. Now let's move toward the advantages. So it helps in better control over business operation, clear financial direction, and it also helps in achieving organizational goals. Limitation: time consuming to prepare. It required accurate data, may become outdated if not updated regularly. Key points: Master budget equal to budget of all budgets. Now let's move toward the budgeting methods. So there are three type of budgeting methods. Number one is incremental budgeting, number two is zero-based budgeting, and number three is activity-based budgeting. So let's start from the incremental budgeted. What is incremental budget? Incremental budgeting is a budgeting method where the previous period budget or actual reserve are used as a base and adjustment are made for the new period. It assumes that first figure are a good starting point for future planning. How it works: starting with last year budget, add or subtract changes like increases or decreases, adjust for factors like inflation, growth, new expenses. Advantages: easy to understand and apply, it saves time and efforts, it provides consistency in budgeting, and suitable for stable businesses. Limitation: ignore inefficiencies from fast budgets, may encourage unnecessary spending, not suitable for dynamic environments, and lacks of innovations. When to use: when business operations are stable, when there are no major changes expected, and for routine or administrative expenses. Key features are based on historical data, simple and easy to prepare, small changes increments are made, focuses on stability. Now let's move toward the zero-based budgeting. So zero-based budgeting is a method where the budget is prepared from scratch, zero-based, and every expense must be justified for each new period. No reference is made to previous budget. How it works: start from zero, identify all activities, estimate cost for each activity, justify each expense, improve approve all the necessary expenses. Advantages: improves cost control, eliminates unnecessary expenses, encourage efficient resource use, and better decision making. Limitation: it is time consuming, require detailed analysis, needs skill management, may be difficult for large organizations. When to use: when cost reduction is needed in dynamic or changing environment for department with high expenses like marketing and admin. Key features: start from zero base, focus on necessity and efficient, detailed analysis required, eliminates wasteful spending. Key concept: every cost must be approved and justified, no automatic carry forward of past expenses. Now, what is activity based budgeting, which is also known as ABB? So, ABB is the budgeting method where budgets are prepared based on activities that drive cost just past data, rather than just past data. It focuses on what activity are needed and how much they cost. Key concept: costs are linked to business activities. Budget is based on expected level of activities. How it works: number one, identify key business activities. Number two, determine cost driver factor causing cost. Number three, estimate activity level. Number four, calculate cost for each activity. And number five, prepare total budget. Advantages: improve cost control, it identifies inefficient activities, and it enhances decision making. Limitation of ABB: it is complex and time consuming, it requires detailed data, difficult to implement in small businesses. When to use: in manufacturing and service industries, when overhead costs are high, when detailed cost analysis is needed. Key feature: focus on activities rather than department, based on cost drivers, more accurate than traditional budgeting, link cost with operations. Now, advantages of budgeting. So, number first is better financial controls. It provides continuous monitoring of financial activities and improving overall control. Number two, resource allocations. Resources are allocated to the most important area, improving efficiency and productivity. Number three, performance evaluation. Actual result can be compared with budgeted figures to identify variances and measure performance. Number four, risk management. It identifies potential risks in advance and allow business to take preventive actions. Number five, profit maximization. By controlling costs and planning revenue, budgeting helps in increasing profits. Number six, cash flow management. It helps maintain sufficient cash, avoiding liquidity problems. Budgeting also have limitations. So number first, based on estimate, budgets rely on forecast and assumptions which may not always be accurate. Number two, time consuming. Preparing a detailed budget requires significant time and effort from management. Number three, lack of flexibility. Traditional budgets are rigid and may not adapt quickly to changing business conditions. Resistance from employees. Employees may resist budgeting due to pressure to meet targets, lack of involvement in planning. Number five, dependence on past data. Some budgeting methods like incremental budgets rely heavily on past data which may not reflect current conditions. Budget variance analysis. So what is budget variance analysis? Budget variance analysis is the process of comparing actual financial result with budget figure to identify differences and analyze their cause. Purpose: to evaluate business performance, to identify deviation from plan, to take corrective action, and to improve future budgeting. Types of variance. Number one, favorable variance, when actual results are better than budget, like when there are high revenue and lower expenses. And number six is unfavorable variances, when actual results are worse than budgeted, like lower revenue and higher expenses. Variance formula. Variance is equal to actual minus budget. Role of budgeting in business. So number first, planning tool. Budgeting helps businesses plan future activities by estimating revenues, cost, and resource required. Number two, financial control. It provides a system to monitor and control expenses, ensuring that spending stay within limit. Number three, decision making. Budgeting supports management in making strategic and operational decisions based on financial data. And number four, coordination between departments. Budgeting align all departments toward common business goals, improving coordination. Let's move toward the conclusion. So, budgeting is a vital financial tool that helps business in planning, controlling, and managing their financial resources effectively. It provides a clear roadmap for achieving organization goals by aligning income, expenses, and strategic objectives. Through proper budgeting, business can improve financial control, enhance decision making, monitor performance, ensure efficient use of resources. However, budgeting must be used with flexibility and regular review to adapt to changing conditions. In conclusion, effective budgeting leads to financial stability, operational efficiency, and long term business success. Thank you.